All right, welcome to this explainer. Today, we are taking a look at a foundational document of business finance, the Statement of Financial Position. Right now, if you were to check your wallet for cash and mentally tally up your credit card bills, you're doing exactly what this document does for an entire enterprise. It strips away the mystery and leaves you with the hard facts.
Here is our roadmap for today. We're going to cover the financial snapshot, then assets, liabilities, and equity. After that, we'll look at current versus non-current items, dive into the single proprietorship, and finally wrap up with formatting the statement.
Section 1. The financial snapshot, taking a picture.
So the Statement of Financial Position, or SFP for short, literally lays out exactly what a business owns, what it owes, and the owner's equity at one specific moment in time. Think of it like snapping a photograph of a business's finances. If you take that picture on December 31st, it freezes time right on that exact date. And this snapshot, it's absolutely crucial. It serves as the ultimate basis for decision-making for owners, creditors, and investors.
Now, you'll actually hear the SFP referred to as the balance sheet all the time. Just know they are the exact same thing. The main objective here is to give us highly accurate data to assess two key things: liquidity and solvency. In plain English, it tells us how easily the business can turn its assets into cash and whether or not it can pay off its long-term debts. It's pretty much the ultimate reality check.
Think about going in for a standard medical checkup. The doctor runs some tests, right? And that final report tells you if your physical body is healthy enough to handle your daily life. Well, the Statement of Financial Position does exactly that, but for a company. It evaluates business performance and stability. It lets managers, investors, and creditors know, hey, is this enterprise actually financially healthy enough to meet its obligations and keep growing?
Moving right along to Section 2. Assets, liabilities, and equity, the core elements.
Okay, so the entire Statement of Financial Position is built on just three core elements. First up, we've got assets. These are the resources the business owns. Think cash or physical equipment. Second, we have liabilities. These are the obligations owed to others, like bank loans or accounts payable. And finally, equity. This is the owner's remaining claim on the business after you deduct those liabilities from the assets. It's essentially what belongs to the owner, free and clear.
To make this super clear, imagine you're buying a house. Step 1, the physical house itself, the bricks and the roof, that is your asset. Step 2, that massive mortgage loan you got from the bank to buy it? Yep, that's your liability. Step 3, the portion of that house's value that you actually truly own, so the amount you've paid off, plus any appreciation, that is your equity. The SFP literally just takes this exact same logic and applies it to a whole company's operations.
All right, Section 3, current versus non-current items. Timing is everything.
Now, in accounting, the dividing line here is usually just one single year. Both assets and liabilities get split into current and non-current items. Current items are short-term, so for assets, we're talking about cash, inventory, or receivables that you expect to convert to cash within a year. For liabilities, it means debts you need to settle within that same year. On the flip side, non-current items are strictly long-term, meaning they last beyond 1 year. We're talking property, heavy equipment, multi-year bonds, or long-term loans.
Actually, it's kind of like organizing a kitchen. If you look around, your current items are your groceries, the milk, the bread, the fresh veggies. You're going to consume those quickly, definitely in a short time frame. But your non-current items? Those are your heavy appliances, like your fridge or your oven. You're keeping those around for years. A business is basically just separating its groceries from its appliances, so everyone knows exactly what resources are available right now versus what's tied up for the long haul.
Which brings us to Section 4, the single proprietorship, keeping it personal.
So, in a sole proprietorship, the SFP has a uniquely simple structure, especially when we look at equity. Unlike those massive corporations with super complex stock shares, a single proprietorship relies on the owner's capital as the main equity account. It sits right there alongside assets and liabilities, directly tracking the owner's personal investments and subtracting any withdrawals they might have taken out for personal use.
And honestly, this straightforward format is incredibly relatable, because it works almost exactly like your own personal budget sheet. Think about it. If you sat down at your kitchen table tonight and listed out everything you own in one column, everything you owe in another, and then calculated your personal net worth at the bottom, you're essentially creating a statement of financial position for the business of you.
And our final stop, Section 5, formatting the statement, choosing the layout. The SFP generally uses two main formats, and it's absolutely vital to know that they both show the exact same information. They're just arranged differently. First, we have the report form. This is a top-to-bottom vertical list.
It starts with assets, lists liabilities right beneath them, and finishes with equity at the very bottom. It's super easy to read in a narrative report. Second is the account form. This one is a side-by-side layout. You've got assets on the left and liabilities and equity on the right. This visual layout perfectly highlights that fundamental accounting equation, that assets must equal liabilities plus equity.
You can think of these presentation styles like two different design layouts for the exact same resume. The facts about your work history and education, those haven't changed at all. But in one layout, the report form, your resume is formatted in continuous vertical paragraphs flowing logically from top to bottom. In the other layout, the account form, it's laid out in modern side-by-side columns to emphasize different sections at the same time. The data is literally identical, it's just the visual delivery changing to suit whoever's reading it.
So, we've seen how the statement of financial position provides this crystal clear photograph of financial health, breaking down assets, liabilities, and equity into a single, digestible snapshot. But I want you to take these concepts and apply them to yourself for a second. If you organized your own groceries and appliances right now, what would that financial checkup reveal about the true health of the business of you? Something to think about. Thanks for tuning into this explainer, and keep exploring.